So right now there's a euphoria around the whole SME market, and a lot of investors, retail investors, are excited to participate in this bull run. Are there any pitfalls that a retail investor should look out for or avoid in this space?
Yes, of course. See, SME as a segment has done very well over the last, let's say 4 years. The entire market capitalization of all the companies on the SME exchange has become more than 10x during this period. The existing companies have also grown, and lot many new companies have also come on board. There is no denying the fact that there is froth in this segment. Uh, if this market cap growth is backed by the earnings growth, or let's say near term earnings growth, it's still okay. But I personally believe that you would see lot many names where the market cap growth is not correlated with the possible earnings growth, the current earnings growth and the near term earnings growth, and that is where my worry is. And these are the segments where actually some of the small investors burn their fingers, because if they are investing without understanding about the company, promoters, underlying industry, balance sheet, leverage, they are bound to make losses. Because I would say probably many of them will not do as well as people expect them to do. Right?
Why do they even invest in this company, sir? Why do you think the retail investor gets in that zone where he wants to confidently want to invest in these companies?
Simply because they are seeing the price on the screen, right? I mean, they're seeing the price going up every day. So it's just that, that greed of making quick money, which we discussed a bit earlier.
Is it like fear of missing out also?
Either the FOMO, either probably FOMO, or the greed of making quick money, making a quick buck, right? Enter today, exit in 5 days, make your money. The point is, when they get stuck, when the cycle turns, when the tide reverses, then in many of them, they won't get exit simply. So again, here I would recommend that it's not that the segment is bad. The segment, there would be gems coming from this segment. There would be companies coming from this segment which would do extremely well. Some of the companies from this segment have migrated to main board and have created substantial wealth.
Multi-baggers.
They have been multi-baggers, more than multi-baggers. I think they've been sustainable. I think I'm not, see, growth per se is not I'm not a big fan of multi-bagger, but the multi-bagger has to be sustainable multi-bagger. Like, it can't be a 20x and then 80% drawdown, 80% down from there, right? That is no growth. Growth has to be sustainable. If it's a 20x, then it has to remain 20x for a certain period of time, right? I mean, and then probably further consolidate and further grow from there, not like zigzag coming down and all. So my point is that while the segment will produce gems, but I have my own doubts with if majority would be gems. I am in the camp where I believe that a small minority will be gems coming out of this sector, and a good part of the companies will not create sustainable wealth. And hence I am worried about retail investors closing their eyes and just putting money like left and right in these companies, because over a period of time, by the time market is a weighing machine in the long term, right? It's a voting machine in the short term. So by the time markets start weighing these companies, a lot of them will come to their right place. And hence again I will recommend here that possibly, going direct is not an option, but the problem is that to go indirect also, they have to go through, some of these platforms such as PMSs and AIFs. But then again, there the cutoff barrier is high. They can't put a few lakhs and participate through these platforms. Even these platforms will make mistake for sure. It's not that every PMS manager or an AIF manager is the smartest guy and he's investing in the right name. But at least they're doing their homework. At least they have built a research desk in their organizations. At least their entire team is going, meeting the promoters, analyzing the balance sheets, understanding the ecosystem, doing their own dipstick check. So the possibility of them making losses will be definitely lower than the average man on the street. That's one way. Second is that I will still say that there is absolutely no point in just having the herd mentality, because at the end of the day there are situations where the entire pack of herd goes down the hill. Right? And I think that is what is happening in this segment, which is actually making me very cautious. See, it's not that I'm not optimistic about this segment, right? I mean, I know there are very good promoters which are wanting to come, and there are very good companies which will list in the next 12 to 18 months, and I know they will create a lot of sustainable wealth. But what I'm worried about is the way this whole euphoria is panning out, that a stock lists and it just keeps on doing back-to-back circuits and the market cap suddenly doubles in a month or so, or trebles in a couple of months post-listing. The listing itself is much higher than where the IPO came. So what suddenly happens that from the time of IPO, the stock is 5, 6, 7x in a period of 3, 4 months, right? Which is actually making me think that, you should enter, either you have to enter at the initial stages, right? I mean, if you study, there's a company coming to public, you're studying all their, DRHP, you're studying the balance sheets, you've gone and met the promoter, you visited the plant, or you've done a little bit of scuttlebutt, you come on day one. Entering at the peak of the euphoria, entering at, the top of the valuations and then see it, fall down substantially. I think that is not the right recipe of investing. I think that is a recipe which at some point of time will make you go away from the market and not help you enjoy the fruits of sustainable wealth creation, which this market will certainly offer. Again, I'm telling you, we come to the same point that markets have to be played in the right manner. Market will create a lot of wealth, but not in every pocket, not in every entity, not in every form, right? So it has to be played in the right way. Unless you are an expert, you are a subject matter expert, unless you understand those underlying companies, then you do what you want to do. But if you are not an expert, if you don't even know, just catch any investor who's invested in an X company, let's say X SME company, and ask him what is the net worth of the company, what is the revenue of the company, what is the EBITDA margins, PAT margins, debt equity, debt EBITDA, ROC, ROE. I am sure a bulk part of them will not be able to answer any of these questions, right? This is not the right way, is what I'm just trying to say. So that is where the education concept comes, that they have to told how to participate in the right way. Somewhere they'll falter, they'll make mistakes, and then they go back. We don't want people to go back. We want people to come and stay in capital markets, right? And create sustainable wealth for themselves.
Play the game right.
When such an euphoria happens, markets become very speculative in nature as well. So, somebody is entering at the top of entering a company at which the valuation has already peaked. So these are the kind of things which people are unaware of. What happens to a retail participant is that you track a particular stock, you see every day it's hitting upper circuits, it's 5% up, 10% up, every single day for a consistent period of time over 2 or 3 months. And at some point when you keep seeing that stock go up, you never can truly figure out what the right time to enter that stock is. So you're just buying it when it is going up. And that sort of investing, I would say, is what puts people away eventually from markets, like Sir said. So, having said that, I also am of the opinion that given India's growth trajectory and given India's development across all sectors, whether that's infrastructure, whether that's commodities, textiles, mining, all real estate, every sector, India is looking at a decade-long bull run. But when I say that, I have to be very careful when I say this also, that when I say a bull run in companies which will... So what happens in a bear market, right? Like there's a correction that happens and companies in which there is high conviction will always remain. Those will continue. So when I say bull run, the bad apples will always come out. But companies with high conviction or with high growth, which have really strong fundamentals will be supported. And there is less speculation, I would say. So it's very important that a retail participant understands all of these things before they come and invest in the SME segment particularly.
And it's very important because, like, for everyone listening, I think you will not only be doing a disservice to yourself by losing your money, you'll be doing a disservice to the entire nation by not investing in the India story correctly. So make the informed choice by making sure that, like, whatever investments you're making is an informed one, not just a speculative one.
Absolutely.